This is Chicago's very own WGN Evening News at 4.
Well, it's been a few weeks now since the Federal Reserve cut interest rates by a half percentage point from what was a 23-year high. Stocks soared to all-time highs, but do those benefits trickle down to the average consumer? Joining me now to discuss this is Craig Bolanos. He's the CEO of Wealth Management Group. Let's start with some of the ways that consumers should feel the rate cut and how long it could take. Craig?
Well, Ben, I got to tell you, I'm excited about this because everyone thinks interest rate cuts are for investors with stock markets at all-time highs. But the truth is it's really for us as consumers, because anytime you can lower the cost of borrowing, that puts money inside of a household budget. And when you can free up money inside of a household budget, that keeps consumerism alive and helps keep a soft landing intact.
So how can consumers be sure that they're taking advantage of lower interest rates?
Part number one, rip open your statement this month when you get it in October. Take a look at all of those credit card rates. And if you're paying 19 to 23% interest, it's time to shop and find a 0% credit card. And Ben, you know what everyone really wants to talk about? It's mortgage rates. Gone are the days of 8% mortgages, 7% mortgages. Most people are at 6 in change if they're not paying points. If the Fed gives us a couple more doses of Tylenol, that's some additional rate cuts, we could see 30-year mortgages starting with a 5 in the year 2025. And boy, that would be welcome news.
Yeah, that's a good point, though. So while mortgage rates have come down a bit, the reality is most people are still below what the current rate is. So now is not necessarily the time to go out and think you're going to get a new lower deal.
No, you're right. Anybody who was financing or refinancing their mortgage during the days of zero rate interest policy, that was savings accounts that paid nothing, auto loans and mortgages under 3. No, there's no savings there. But for everybody who started to move, change properties in 22, in 23, and 24, brighter times are ahead. And that might just start leading to an increase in inventory. And wow, wouldn't that be welcome news for all buyers, especially first-time home buyers?
Yeah, it's not just mortgage rates, it's inventory as well in the real estate market. Craig, I want to ask you, we hear about the port strike out east, the worsening crisis in the Middle East. There is, I think, part of all of us that just kind of holds our breath thinking like at any point, we could see some sort of big correction in the markets or everyone could get scared. What would you tell people who are investing either through 401ks or through stocks and bonds, about this current very volatile world environment that we're in?
Ben, using WGN as a platform, I'll tell you what I told clients this morning. The port strike from Texas to Maine, boy, it's newsworthy, but this too shall pass. All strikes have proven to be temporary, but expect the longer it goes to see some inventory disappear on the stores of retail shelves. No panic, but there's going to be some challenges. The ballistic missiles that came from Iran to Israel this afternoon, incredibly newsworthy. You would have thought markets would have sold off more, but I think the real story is the increase overnight in energy prices now as a result of the escalating tensions in the Middle East. But if you're a long-term investor for your 401k, I don't think you need to worry about it turning into a 301k. So do not panic. Panic is not a plan, but reset your asset allocation, rebalance your portfolio, and invest with a purpose for the long term. And this too shall find a way to smooth its way over.
All righty, Craig Bolanos, thank you. We always appreciate your perspective. You can check out Wealth Management Group. They have locations in Inverness and Downers Grove and online at investwithwmg.com. Thank you, Craig.
Great to be with you.